Hello everyone, welcome back to my channel. So this video marks the end of week 21 in this road to 200k challenge. We have a lot to unpack in this video, especially during the events that occurred during this week. And one of the things that I left out from the previous one, even though I mentioned it early on in that previous video, was that we were going to determine which was the average price or the cost basis for four motor company shares that I had at the time. However, as you can see right here, however we failed to do so because of some time constraints from my side. But here it is. At the start of the week, the average price of acquisition for four motor company shares was $11.19. However, a lot of things happened during this week. It was a week of two halves, and so we'll get into those. And of course, because we also acquired more shares of four motor company in the meantime, of course, this average price or cost basis came down as well, so we will go through that in a bit. But for the time being, it needs to be said that the beginning of the week started very good, with some hopeful signs that the Fed is going to deliver, besides a near certain interest rate cut of 25 basis points on Wednesday on the Fed's meeting on Wednesday. There were also high expectations in terms of the number of interest rate cuts that would take place next year in 2025, and so because of that high expectations, stocks continue to climb, and especially the Nasdaq, of which this QQQ ETF is based on. It climbed to a record high value, and that came out as a big disappointment because the Fed, it simply stated, the Fed chairman, Mr. Jerome Powell, saying that instead of the four expected interest rate cuts for 2025, they were only expected to make it twice. And the reason for that is that inflation remains sticky, above 2%, and the economy is still going at a pretty good performance. And so there is no reason for the interest rate or for the monetary policy, for that matter, to become looser as the year goes on, as the year 2025 goes on, if economic conditions remain this way. And markets took it as a big blow. The feeling was that there was a big disappointment, and because of that, indexes and stocks came crashing down from late in the session on Wednesday, and also on Thursday as well. On Thursday, some of the losses were not as big as in the previous day, but there were some losses. And then yesterday, on Friday, as the reading for inflation came a little bit lower than expected, inflation year on year, the consumer price index, which was expected to be at 2.5%, came out at a 2.4%, and so that gave the investors a little bit more hope that there will be some additional interest rate cuts for 2025. And so this was what happened over the week, and as you saw at the time, on Monday, we had three short positions on three short put positions on the QQQ ETF, and if you recall, I bought back those puts late in the session, and basically sold puts again for the next day. Now, with the benefit of hindsight, this turned out to be a bad move, but of course now we know it was a bad move. At the time we didn't know that it was going to turn out this way, but because of that we managed to sell puts with a strike price of 536, so we bought back those at 532, sold and at 530, these puts at 536. And then basically what happened was that because these puts were assigned on the next day, all right, because simply the markets fell off a little bit, we were assigned these shares. And then on Wednesday, when we sold a call here, as you can see here, even though the premium was extremely juicy, on Wednesday we could not manage to sell those shares back because the Fed meeting, the press conference took place, and stocks came crashing down, and so these calls expired basically worthless. And expired in a way because it expired worthless because the price of the index came down into the 518, 517, something like that. And so at the next day, because we had to sell calls at the acquisition price as a strike price, we could only get a very meager premium because of the price of the shares of this ETF. And yeah, basically this was even a 2-day call, not a only day, because not a 1-day option, because otherwise I wouldn't be able to get hardly any premium whatsoever. So we decided to go for a 2-day, expiring yesterday on Friday, and so we get even so this meager premium. And yeah, so we basically offset our huge gain in terms of premium that we got on Wednesday. But yeah, in the meantime it has recovered a little bit. Still these calls expire worthless, so we'll have to see at the beginning of next week how things turn out. Now, of course, as you saw at the beginning of the week, we also bought some shares of Ford Motor Company to take advantage of the lower price. But then this result of the press conference of the Fed basically opened up an additional or it made it even bigger of an opportunity for us to acquire more shares on Ford Motor Company, so that we could basically bring our cost basis even further down. As you can see, on this particular day, the day the press conference took place, and this was already very late in the session, we managed to buy some stocks at 9.77, at $9.77, and we also the next day, if I believe, yeah, on the next day, also very late in the session, we managed to buy 250 more shares at 9.73.5, and yesterday we managed to buy 1,350 more shares at 9.82 and 9.88, and nonetheless the option that we had sold at the beginning of the week, which is this one with a strike price of 9.82, even so this ended up expiring worthless. So I really want to emphasize this, because this is a very important point to make, is that and probably the best way for us to do this is even to basically write this up, because I really want to emphasize this point right here. I'm going to put this a little bit smaller to make sure that everyone can have a very, very good understanding of how these things go, because I think this is very important. So basically what I want to say is that selling a put with the purpose of lowering the cost basis is not a guarantee that you will be able to do so, because in order for you to acquire the shares, the stock price must meet two conditions. It's not only one. It has to meet two conditions. And what are these conditions? And these conditions must be, of course, they must be basically together. They must meet at the same time. So basically, what are these conditions? So let's just do it this way. The price must go below the strike, and this I'm going to emphasize, and this must happen at the option's maturity. All right. Otherwise, you won't buy anything, and your cost basis remain the same. And why do I emphasize this? Simply because, as you can see here, and I'm going to show the graph on Ford Motor Company. Let's just pull the chart here. As you can see, so the price during this week, the price, and this is approximately where the strike is. This is where my mouse is at the moment. As you can see, the price went several times over the week. I'm going to pull this here. So this is the line of the 982. So you see, for example, in the last 2 days of this week, the stock went for a long time. Let's just do it this different. Let's just pull up the weekly. So as you can see, during this entire period, you see the stock went below the strike price. So the option was in the money, but because the stock in the meantime recovered from this low, we ended up empty-handed. So the options expire worthless. And because we are the seller of the option, not the buyer, we don't have the option of exercising early. And so that is why and remain the same. The only way you can reliably lower your cost basis is by buying the stock outright, even though you will have to pay a fee and won't get a premium, right? But this is really necessary. I was able to buy some shares here at 977, 973.5, and this allowed me to significantly lower our cost base, as you will be able to see in a few minutes. But because otherwise, if I didn't do this these acquisitions, I would have come empty-handed, and our cost basis would have remained the same. And so that is why we need sometimes to diverge from our strategy and buy directly the shares. In terms of the Pfizer shares, nothing came out of the ordinary. The stock took a hit due to the Fed's decision, but it never affected our puts. The puts would expire worthless nonetheless, and we bought even those back to buy some additional shares of 4 because the price was so low, and this was a very good opportunity. And we, as you can see in the graph here, the stock was already coming back during during yesterday, so we had to also keep in mind that this opportunity would not come again. The price would probably continue to rise on Monday. So yeah, well, our window of opportunity has already gone, but we managed to make the most of it. And also when it comes to the QQQ, our ATF, as you can see here, and I'm going to show the weekly graph, it took a big hit here on Wednesday, but then even though it came down even worse on even lower on Thursday, on Friday it started to recover. Of course, at the end of the session it paired some of those gains, but still it was an upward, it was a positive day, so we can't complain too much about it. So now we'll have to see for the next week now if we will be able to sell some calls on it. The 536 call is basically it doesn't give us any premium at all, hardly, but we'll have to wait and see what happens. Even if we have to stretch our maturity for 1 or 2 more days, for sure there will be some good opportunity for us to do so. And yeah, basically this is it. We just now need to put those trades in our scoreboard and see where we are in terms of the average price of 4, because this is going to be an important step towards getting rid of these shares. So these were the trades that we did for Monday, and yeah, this is where we bought back the shares, and this is where the shares of QQQ is, and this is exactly where we left. So let's just insert here in our scoreboard. So we bought those back at 1 cent a piece, and we paid a commission of, so we received a credit of 89 cents and we paid here 62. So this is a difference of 27 cents. So basically we receive 27 cents. Right, so nothing extraordinary, but still it's a credit, and it's always good. We bought back these, so we must keep these as they are. This cash covered put, this ended up expiring worthless. All right, and for some reason there is no formula here, but we are going to copy here. Right. Alright, so this is good. Now this expired worthless, as you saw here, and yeah, basically expired. We managed to get a pretty good return out of it. Alright, so let's see. As you can see here, the 4 puts expired worthless, so nothing came from them. And yeah, we have also to insert this one, because basically what we did is we sold this put at with a premium of 70 cents, and we paid a fee of 207. So let's come here. We manage also to, same here, this one would expire on the 17th, I believe. Yeah, this would expire on the 17th, right? So let's just put here, and we pay the commission of 207, I believe, right? Yeah, it was a commission of 207, so we sold 3 contracts. This was 3 contracts, and with a strike price of 536. This was a cash covered put on the QQQ. Right, and basically this expired here, and for some reason this is not copying the formula. All right, and basically we were assigned this one was assigned, and because I cannot remember what was the closing price, which doesn't really matter because when we sell back, we didn't realize any loss, right? So for the time being, let's just consider the price at which we sold. So this is 500 at which the stock is at the moment, so it's 520.9. For 536, this is $15.10. So let's just put here that, well, let's just pretend that this is a loss, which is nothing important. All right, this loss is a hypothetical one and will no longer be this large when the market opens on Monday. Now for the next one, let's see what happens on the next day. And this is where we are. So the stock was assigned, we have to buy 300 shares of these. The next day, let's just pull this up over here. Yeah, we sold a very juicy call on this, which was on the 18th. Yeah, on the 18th. So let's just copy here. It's just on the 18th. This would of course expire on the same day as it did. QQQ, covered call. The strike price was 536 as well. So it was 3 contracts and we managed to get 191, and our commission was 136. Of course, as we know, this expired worthless because we still hold the shares. And then on this particular day, we also bought 300 shares of 4 at the price of 977. So this is a buy here at 9.77, and we bought 300 shares. So let's pretend it's just 3 contracts. All right, so let's keep it like this. For some reason this is not all right, this is not correct, and we paid in commissions 1.51. So we received no premium for this and we paid 151. All right, now this is correct for the time being. And moving up, as you see, this call expired worthless. So we come on to the next day, which is we sold again, but this was a 2-day call, so 3 contracts, and we now have to determine which was the average price because we sold 2 of them at 12, and then at the third one at 7. This was because the order filled up for only 2, and then for the third one I had to continuously lower the average price. So this is 19th, right? This expired at 20, which was yesterday, and it did so. Let's just copy here. This was again the QQQ covered call, 536, 3 contracts. We managed to get, so this would be, so it's 12 times 2 plus 0.7. Let's just do it this way. So let's open the parentheses here and then divide it by 3 to get the average price. So this is the average price. Let's just pull back these decimal places, and we paid a commission of 241. So we paid 241. We also let this one expire worthless, so there was nothing to be done here. Of course, the premium this particular stock was the return was meaningless. I don't know why it says divided by 0, but yeah, whatever. The return doesn't even matter because it's insignificant. Oh, this is why, because the collateral for some reason was not moving. Let me see. Wait, there must be something wrong here. Alright, so now it's correct. There was something wrong here. Yeah, these formulas are acting up, so now it's correct. Of course, this is a meager return, doesn't really matter. So yeah, and this is important because on this particular day, on Wednesday, we managed to buy back one of these Pfizer puts, and then on the other day we bought a second one, the second one. And so let's just pretend that we bought back both at the last day. So this is 166 in commission, and this is the one. It's 166 in commission, and we bought back at 1 cent. And I believe, yeah, this is at the price at which the date at which we bought it back. We closed the deal, so it's still not impressive at all, but yeah, no problem. And now we bought, even on Thursday, 250 more shares. All right, so let's just put this one right here. We bought these at 9.73.5, which is rounded up to 9.74. We bought 250 shares, so let's put 2.5. And as you can see right here, this is the sum, and we can also sum these to see that the numbers match. 5 plus 1168.2, which you can see this is the value. All right, and this is the value that matches with the values we have right here, right? So this makes sense, and we managed to pay in commission, so it's 101, so it's 127, and so we received 0 premium and 127. And yeah, this is done. Now coming back here, this is the put that we bought back. Now yesterday we bought 350 more shares here, as you can see, with the price of 982. So again 20, and we bought this at 9.82, and we bought 350 shares here, 9.82, and we paid 1.77 in fees. So we received 0 premium and 177. Now the next one is that we bought back these puts from Pfizer as well, and we paid 118 back. So the puts are here, and we bought back at 1 cent. We bought back also at the day at maturity, which is something that I usually do not. I never do this, but I wanted to get the collateral back in order to buy more shares. And so that is why I decided to go ahead and basically take as many shares as I could for this particular stock. And this one we bought back at 988, and we paid 505. So it's 9.88. These were, how many shares? These were 1000 shares. So this is the same as 10 contracts, and we paid 505. We received 0 premium. Alright, so, and this is it for now, at least. Now we need to understand how much is the average price for this, and also it would be good if we could account for the commissions that we paid, but because this is nothing that now probably doesn't make much sense for us to do this, or perhaps we can. Yeah, perhaps we can. Let's just do this and make a rough estimation. Let's see. So open here. So for the column, yeah, so put this one in here times 3 contracts. Now plus open and close. Now this one times this one times plus open close, and 350. Actually this is not correct because it's wait, this is not correct because it's 313, no, it's 314 and 316. Yeah, this is the correct one. So now we can copy this, put it in here, switch for 17, and then again we plus open and close brackets, and we can do basically the same here. Let's pull this up a little bit more, and we use the 18, so 18 here and 18 here. Now we're gonna adjust the denominator, and we are going to use the 14 here plus, because yeah, this is correct, the 16 and the 17 and the 18. All right, and so we managed to get an average price of $10.38, which is very good. This will allow us to try to sell calls at a 10.50 strike price, and which I believe it will be available next week. And exactly, there it is, it's 2 cents, so this should offset our commissions, and we will be able to sell 32 contracts on this, which will give us not the most exciting premium for so many contracts, but still this is an option that we can consider, even though we'll have to see how the day develops, because if the price comes back very quickly, it might make sense to just wait and just sell the stock outright. Now of course we are not going to sell, if we are going to sell the stock outright, we're not going to sell at 10.38. We're going to sell a little bit higher because we need to make room also, or to have some margin for the commissions that we paid. All right, even though they are not that significant, this is something that we must always keep in mind. But yeah, I believe this is so far the most important thing. These are the only batch of 4 shares that I bought outright, if I'm not mistaken. Yeah, so buy. Yes, I only bought 4 shares this past week, so these are the commissions that we have to go up against. All right, and yeah, this is something that we have to keep in mind. Actually, we can keep this in mind because if we can do this, for example, we go back here and we basically sum up these values like this, and then like this, and this, and this. This should give us, but this is way too much. I have to take a look at this because this does not make sense as it is. All right, so we will have to delete this because it doesn't make sense that the price came up so high. All right, so we will have to see the reason why, but for the time being, this is all. For the amount of this is around 11-12 euros at most. So this should have a negligible impact on the average price. This might go up for 1 cent or 2 at most, so nothing really significant. If we can manage to sell them at 10.40, 10.41, this should be good enough. But we'll have to wait and see what happens. For the next week, we will have to see how the Monday trading starts, so that we can sell again covered calls on QQQ, and see how it develops. Also the options for in order to see if it makes sense or not for us to sell these options on these call options on 4. We still have a little bit of buying power left. We have about 5.5k, so depending on what the market does, we'll see if we use this buying power to buy more 4 shares, even though buying 5.5 k dollars on 4 shares with this stock price, the effect on the average price is going to be very, very small. So I'm not tempted in buying more shares. I think this will be enough, but we'll have to see, and probably we'll get back to selling more puts on Pfizer with this kind of buying power, but we'll have to see basically how it goes. For the time being, this is all. Feel free to leave your comments and your questions in the comment section down below, and also feel free to like the video and subscribe. I'm also available on LinkedIn in case you want to speak with me about the challenge or any other concerns that you may have, and we'll reconvene on Monday night to see what were the trades that we did for the week 22 of this challenge, and I'll see you there.